We have not been willing to put money in the S&P 500 for a number of years here because we think it's flawed.
This is the time of year when a lot of calculations are done. And Joe, let's start with you because you've been doing a lot of thinking, a lot of calculations. And I think what you found will surprise a lot of people. And that's why I ask you this question to begin with. Do you think we're headed into another decade of lost stocks?
No, no, I don't actually think that. I think that it is one of the range of possibilities. And actually, I hate the term, I hate talking about things and saying stocks because we all know what we mean when we say that, right? We mean the S&P 500, but that's not all the stocks out there. There's lots of stocks out there. But let's talk about the S&P 500. We have not been willing to put money in the S&P 500 for a number of years here because we think it's flawed, because of the concentration of the index where you've got, and essentially you're not getting the diversification that you are supposed to get when you buy 500 stocks. You're essentially getting a third of your money, or even as much as, if you, depending on how you count it, as much as 40% of your money in the technology sector. Now, that would require you to reclassify some things. Google and Facebook, or Meta, whatever you want to call it, a couple of those stocks are in the communications sector now, but Google's a technology company. Anyway, point is, you don't get the diversification that you really want when you buy the S&P 500. So we haven't been willing to buy it. The problem with that is it's been the thing that's outperformed. It's beaten everything. Last year was a great example. I mean, it just beat the pants off of everything. We had good returns out of the things that we own, 15, 16% returns, but they pale in comparison to the 25 plus that you got of the S&P. But here's the thing: when we do these, I do take the month of December off to think. I know people probably believe I'm sitting at home drinking eggnog, but I'm not. I actually do think, but I don't do what most of the Wall Street investment houses and other investment advisors do. I'm not trying to figure out what's going to happen in the next year. What I'm trying to look at and try to get is the really big picture. What's going to happen over the next 5 to 10 years? What are the trends that are going to shape the economy and the markets over the next 5 to 10 years? And one of the exercises we do is to say, hey, what's the return on the S&P 500 going to be over the next 10 years? Now, a lot of people use the Shiller-Cape ratio to figure that out. I actually don't think that's a really good method. And I use what's called the Bogle method after John Bogle, who says, hey, if you take the beginning dividend yield and then you add earnings growth and then take the annual change in the PE as a percentage, and you add all those things together, that's going to be your very good approximation of your average annual return over the next decade. And I got to tell you, you go back and look at the history of it, man, it works really well. I mean, we're much better than any other method I've seen. So, but you have to make some assumptions, just like you do with any of these things, right? You don't know what earnings growth is going to be. You know what the current PE is, and you know what the current dividend yield is, but you don't know what earnings growth is going to be, and you don't know how the PE is going to change. But you can make some assumptions. And I think what you want to do is try to think about, what is what's the most logical, most I don't know, I don't want to say the most conservative method, because that's not really what you're after. You're trying to be as accurate as possible, just a reasonable a set of assumptions. So if you look at this week's piece, the piece that I wrote up over the weekend, I included a chart there where I made a number of assumptions, and we got 8 different scenarios, and you can come up with more, I'm sure. I mean, look, we looked at one that says, hey, what if you get the long-term earnings growth rate? Well, believe it or not, that's not very high. It's 6.7%, which makes sense. Corporate earnings can't grow faster than the economy itself. And so if you look at corporate earnings across the entire economy, they grow right about the rate of nominal GDP. S&P 500 theoretically is 500 of the largest, best companies in the country. It should grow a little bit faster, and it does. But 6.7 is not a high hurdle, but it is what the long-term average is. And if you're talking about what's going to happen over the next 10 years, you don't want to be thinking about what's going to happen in the next 2. So earnings growth, if it averages the long-term average and the PE doesn't change, you get about an 8% return a year. Now that assumes that the PE doesn't change. And you have to realize, though, that the PE is very high right now at about 26, 27 times earnings, and that's times trailing earnings. So that's a high number. And by the way, the Schiller PE is even higher. Schiller PE today is around 38, which is, top 1% of what it's ever been. So anyway, we did that. So the PE stays the same. We also looked at reversion to mean. What if the PE just goes back what the long-term average is? And you get that average earnings growth of 6.7, and it goes back to your long-term mean. Well, here's one of the surprises you find when you do this exercise. What's that long-term mean? What's the long-term average? Well, if you go back to 1970 on the S&P 500, the long-term average PE, trailing PE, is 19.8, which is a number that I did not expect. I thought that number was going to be closer to 15 or 14 or something like that. It's almost 20. So just going back to a 20 PE from where you are today is really not that heavy of a lift. And if you do that, you still get a decent return, I suppose, 5.2%. But then we looked at what happens if you get better earnings growth. What happens if you get worse earnings growth? There's lots of different scenarios here. So anyway, the bottom line is that there's a range of potential outcomes that runs from about a -1.25% a year to a best case scenario maybe of about 11% a year. And that 11% a year is if you get 10% earnings growth and the PE doesn't change. That's, I think, highly unlikely, but it's certainly within the realm of possibility. So what we try to do is say, hey, what's the reasonable case here? So the reasonable case to us is that you get historical earnings growth of about 6.7%, and the PE falls to about 15. And the reason we chose 15 is because if you were to go back to where the low PE back in the 1970s, well, that was like 7. I don't think we're going back to 7. It's possible. Anything is possible, but I don't think that's a reasonable case to make and say that's the reasonable case. That's the extreme case in the negative way. So if you go back to a 15 PE and you get historical earnings growth, you get about 2.5% a year. To us, that's not worth investing in. That's going to lose money on a real basis. And so to us, you got to look other places for your equity exposure because the S&P 500, the reasonable case for the next 10 years is not that great. So that's what we've been doing, is looking for different ways to invest in equity that is not the S&P 500.
Well, Steve, you've done a lot of research and thinking in those same in that same vein. Are you on board with Joe? You got a different opinion.
Yeah, I'm mostly on board, but I would throw out one little curveball there, a little caveat with this is I'm pretty much in the same place of looking at that historical earnings growth. P falls to 15. You get that about that 2.5% projected annual return and we're going to get to this in other videos as to why a lot of things are lining up to probably get you some PE compression. And again, with the caveat, we're talking the S&P 500, where most of the money is, but not where most of the stocks are. I would actually probably, if I'm a betting man, go a little lower than that. And that's because, this stuff doesn't usually move in a straight line. We've seen that. We've gone well above where expectations are, and that's not unusual historically. Historically, usually how this, resets is violently, and it usually overshoots. So that's why I would actually maybe go a little bit more on the downside, is that once this freight train gets moving in the opposite direction, my expectation with the behavior of crowds and how people act, will actually probably come in a bit lower. That would be the only kind of caveat I'd stick out on this. We're pretty much, on the same page here. And again, we're going to get into this in other videos in terms of why we are expecting some compression on the multiples. But I would also in that chart point out to that repeat of 2000 to 2009. That's what happened the last time we got this much concentration risk. Actually, not even this much, but we got kind of crazy concentration risk. We got crazy multiples. We ended up with stocks actually doing an average annual that was in the negatives. I got to say that wouldn't surprise me, that we get an overreaction to the downside after having so many years of things really kind of moving in an irrational way to the upside.
Joe, at some point, as Steve was talking, I saw a slight smile on your face. How do you want to respond to that?
Well, I'm the ultimate contrarian, and I always just like to make an argument. So I will tell you what the optimistic case is in our case, and it's based on what we expect, sort of. One of the things I find interesting when I look at history is if you look at earnings growth during the 1970s, which was an inflationary decade, and then you look at earnings growth during the 1980s, which one of those do you think had the higher earnings growth? Well, it's not even close, actually. It's the 70s. The 70s, you had almost 10% a year earnings growth. And in the 80s, that number was half that. But yet you had a much higher return in the 80s than you did in the 70s because interest rates fell. And you expanded that PE multiple. And that goes back to what the formula is. Your future return in the next 10 years is dividend yield, current dividend yield, plus earnings growth, plus the change in the PE. So you had a high change in earnings growth during the 70s, but you had a compression in the PE. The PE went down, and you ended up with a negative real return on an annual basis through the 70s. So what if we do get inflation? That's what we're expecting, right? We've written about this numerous times. We're going to have a long think piece coming out this week that will be available on the website for download. We'll get that out this week to clients too. That'll be sent directly to them. But if you're not a client and you want to read this, you can get it from the website. It'll be a download on the blog. A long piece that talks, it kind of updates our views on why we think we're going to have a higher inflation, higher interest rate environment going forward. And all the things that we laid out 2 years ago when we wrote Dawn of a New Era, all that stuff's still in place. And some of this stuff is kind of inevitable. I was thinking about it. It's like, well, it doesn't matter who the president is really, or who's in charge of politics or what policies are. The U.S. population is going to continue to age. That's not going to change. Doesn't matter what policy does, unless one of those policy changes is to let a whole bunch of immigrants in. If that's not the case, then you're not going to change that equation. Anyway, here's an optimistic case. What if you do get higher inflation, but not extreme like we did in the 70s? So maybe you can push that number, that long-term average earnings growth from 6.7, maybe you push it up to 8.5, maybe even 10, which is what it was in the 70s. It was actually 9.9 in the 70s. That higher inflation, you got to remember, earnings are nominal. If you have nominal growth, you're going to get higher earnings. So what if you push that number up to 8.5 or so on the earnings growth from 6.7 or maybe even 9? And then you have the PE drop, but not as much as it did in the 70s. You go back to that 15 PE maybe. Well, in that case, you're probably looking at returns somewhere at around 7 to 8%. It's not terrible. Now, the risk that Steve highlights still exists. That concentration risk is still there. But I suppose you could make the case that could be corrected without a big correction in the average. I don't think it would be easy, but I guess it's in the realm of possibility. The point is, I think that people want to put a number on this and say, this is what I'm going to get. Because it's so much easier to do your financial planning if you know exactly what you're going to get over the next 10 years. But life does not work that way, guys. We don't know what the future holds. None of us does. So we have to kind of look at this range of possibilities and say, you know what? There is an optimistic case to be made here. It's not our base case, but there is an optimistic case to be made. And you can't discount it completely. It's out there. So look, I don't know what's going to happen over the next 10 years. I tend to be more along the lines of Steve and being fairly negative about the S&P, mostly because I think when you look at historical returns in a rising rate environment, large cap stocks are not necessarily the place to be. And in particular, growth stocks are not the place to be. Rising rates favors value. That's one of the things that is very difficult in this business. We don't have anything to go on but the past, and the past does not repeat. I think it was Mark Twain that said the past rhymes sometimes, but it doesn't repeat. I'm not even sure last year it didn't even rhyme. We had a rising rate environment and growth outperformed big time. That's not supposed to happen. That's not the way that works, but it didn't matter. That does happen sometimes. So anyway, we take things as they come. We've got a base case, which we think that the return on the S&P over the next 10 years is somewhere south of 5%, which means it's probably not something we want to put a lot of money in. There may be times where if you get a big sell-off in the market, maybe there's times where you want to own it or trade it, but we don't think that's the long-term place to be over the next 10 years. So We're going to be looking for some alternatives, mostly in the value space, maybe small and mid cap. And we'll see what happens with international. International has lagged for a long time, and these things go in cycles. We would expect an upcycle in international stocks at some point. It's not going to happen, though, unless the dollar falls. And that just isn't happening right now. So anyway, that's what we're looking for.
This is just the beginning of the discussion. We want you to come along with us on the journey. So be sure you put your comments in the section down below.